Welcome back to our intermediate financial accounting class. In our last segment, we started talking about the last of our financial statements, the statement of cash flows. We spent most of our time talking about why cash and the statement of cash flows are so important to our decision making and to our business and to our analysis of other businesses. Now that we've talked about the importance of cash flow, it's time to start talking about the statement of cash flow itself. And we're going to start by talking about what FASB's goals are for the statement of cash flows. They wanted to make sure that we provided information about cash inflows and outflows during the period. We wanted to make sure that we were summarizing operating, investing, and financing activities of a business. This is the only place that we see information broken down into these categories, although I have to say there is a push right now, especially with the IASB, to create a breakdown of the income statement and the balance sheet that also follows this operating, investing, and financing layout. The only problem with the proposal is that the balance sheet wouldn't actually balance. I don't know what you'd call that, an imbalance sheet, I suppose. But there's this push because it's such useful information to investors that maybe we should be providing it in our other financial statements as well. In addition to breaking down the activities of the business, FASB also wants to make sure that the statement of cash flows provides information about liquidity, financial flexibility, and risk. Now, liquidity is how quickly we can get the cash together to handle an obligation that comes up. Financial flexibility is how quickly can we get the cash to take advantage of an opportunity or to deal with a disaster. So it's more future planning than current obligations like liquidity is. Risk, of course, is a long-term measure of whether our company is a good investment and whether we'll be able to pay back our investors and our other obligations. So all three of these are important pieces of information that all work together to give us a feel for whether or not we've got enough cash on hand. In addition to these three specific goals, FASB's also listed out three questions that they think the statement of cash flows should answer. And they're really basic questions. There's no rocket science here. It's just what we want to make sure that we're providing to our investors as we go through our statement of cash flows. And it's important to keep them in mind as goals with our statement, so we can make sure that these statements turn out the way that FASB wants them to and the way our investors expect them to look. So the first question is, where did our cash come from? And we see that in all the different cash inflows that are summarized in the statement of cash flows. What was cash used for? Those are our cash outflows for the period. And then what's the total change in cash during the period? And we see that as the ending part of our statement of cash flows that younger students that I've worked with tend to forget. They just don't think that's an important number for some reason. And they want to stop with the total change in cash, and they don't go on and get a cash balance. So we want to make sure that our statement of cash flow answers all three of these questions and ends where it's supposed to end, and not just with a summary of the changes this period with no reference to an actual balance. So again, these are FASB's goals, and they inform all of the decisions that have been made by FASB about what our statement of cash flows is going to look like. Which leads us to what our statement of cash flows looks like. What are the formatting requirements? Well, from earlier discussions, you know that the statement of cash flows is broken into three pieces. The first is operating activities, or cash flow from operations. This is all of the cash flows that are associated with the normal day-to-day operations of our business, hence the name operating activities. The next section is called our investing activities. These are all the cash flows associated with purchasing and selling long-term assets. So buildings that we buy or sell, equipment that we buy or sell, if we purchase intangible assets, if we buy available for sale or equity securities, if we make loans to other businesses, etc. All the kinds of investments we can make, that's what goes in our investing activities. And finally, we have our financing activities section. And these are all the cash flows dealing with our owners and investors. So if you remember our discussions way back when, this is all of the cash from our banker and from our owner. So that's what's going on down at the bottom. The nice thing about this breakup is it makes it really easy to see where cash flows are supposed to end up. Anything dealing with long-term PP&E goes in investing. Anything dealing with long-term debt and equity goes down in financing, and everything else, short-term assets, short-term liabilities, a lot of our net income information, all shows up in operating activities or cash flow from operations. But there are a few exceptions. FASB has carved out a few differences from the logical breakdown that we just talked about, because the ultimate goal of cash flow from operations is to be the cash equivalent of net income. So what FASB has done is they've gone through the list of transactions and cash flows, and they've said there are a few things that are technically investing or financing, but we're going to put them up in operating. So that, again, that cash flow from operations number matches up with net income. So for example, the payment of interest would technically be a financing activity. I'm making payments on my debt and I'm paying them interest. So interest should be financing, but we don't put it there because we've got interest expense in our income statement. So we want cash flow from operations to include interest payments. Investment earnings like dividend revenue or interest revenue, technically those are investing activities. We're getting money from the investments that we've made. But again, FASB said, in order to get cash flow from operations to match up with net income, we're going to put cash received as dividends and cash received from interest up in operating activities so that it matches up with dividend revenue and interest revenue. Payments on our asset retirement obligations is another example of these items that have been put in a different place. An asset retirement obligation occurs when we have purchased an asset and agreed to or have been legally obligated to clean up after that asset. So a great example of this is a mining company that when they're done with their mine is going to have to fill in the shaft or the hole. They're going to have to replant the area and clean up any spillage from their extraction operations. That's an ARO. Well, technically, that's part of buying assets. So it should be an investing activity, but we don't put it there. We put it up in operating activities because it matches up with depreciation expense, because I depreciate away the value of this mine or the ore that I'm getting from the mine. And part of that cost of the mine is that ARO. So we include it up in operating activities. Finally, trading securities are technically investments. They should be down in investing activities, but the gains or losses that we make buying and selling or having the market value fluctuate on our trading securities are part of net income. So again, FASB said, let's put them up in our cash flow from operations section. And since they're FASB, we all said, okay. And most companies are okay with this classification and the different structure because they understand this basic principle that we want cash flow from operations to match up with net income. This idea is so important because it leads to these different or unusual classifications. That's one of our key concepts, understanding that cash flow from operations is supposed to be the cash equivalent of net income, and that it changes some of these classifications, again, is a key concept. Now, according to US GAAP, there are two ways that we can create our statement of cash flows. The first is what we call the direct method. The second is called the indirect method. And it really doesn't change the whole statement of cash flows. These different methods only change the operating section. So a direct method statement of cash flows has cash flow from operations that shows cash received from customers, cash paid for inventory, cash paid for interest, cash paid for salaries, cash paid for rent, cash received as interest, etc. An indirect style statement of cash flows adjusts net income and turns net income into cash flow from operations. So we start with net income, and then we look at the change in accounts receivable, the change in inventory, the change in income tax payable. And with those changes and adjustments for depreciation, etc., getting out those non-cash items, we turn our net income number through the adjustments into cash flow from operations. According to GAAP, you can do either one. And FASB recommends direct. They consider that the best information for our investors if we just give them the actual cash flows. Also kind of makes the most sense because it fits with how we do our investing and financing section. They also list cash flows as cash paid for PP&E, cash received from sale of land, cash paid for dividends, cash received from issuance of bond. But the SEC doesn't like that method. So FASB prefers direct. SEC likes indirect. Likes it so much, the SEC actually made a rule that you must include a reconciliation from net income to cash flow from operations in your financial statements. They want investors to be able to see what accruals are in your net income number. And this is what they feel is the best way to make companies do that, by making them pull out the accruals and get back to cash. Well, because of the SEC's insistence, FASB actually changed the rule. So the rule used to be you can do direct or indirect, it's up to you. The rule now is you can do direct or indirect, it's up to you. But if you do direct, in the footnotes, you have to include a reconciliation from net income to cash flow from operations, which is going to look exactly like the cash flow from operating section of an indirect style statement of cash flows, which means that it's not just publicly traded companies that have to do an indirect style. Now, non-publicly traded companies, in order to satisfy GAAP, have to also include this reconciliation. And because they have to include the reconciliation, what's the point in doing a direct method statement of cash flows? I might as well just do indirect and provide what is being required of me. So we still do see direct method occasionally, usually from small mom and pop type shops that think the information is worthwhile, and so they make it. We also see it sometimes on the CPA exam, but in practice, it's very rarely used, especially as companies get bigger. So because of that, we need to talk about it and cover it, but just be aware what we've been doing up to this point in all of our cash flow examples, looking at this reconciliation style, indirect method, net income being turned into cash flow from operations, is what most companies will show. Now, before we go on, this is another of our key concepts, this difference between direct and indirect, and the reason why we just don't see the direct style very often, despite the fact that it's easier to read and understand. In addition to the information that we provide on our statement of cash flows about operating, investing, and financing activities, the rules also require that we include any significant or material non-cash financing and investing activities on our statement of cash flows or in the footnotes associated with the statement of cash flows. So FASB really wants the statement of cash flows to include information about all material decisions and transactions that occurred during the fiscal period. So because of that, they're going to make us show both the cash and non-cash items as part of our statement of cash flows. Now, we're not talking about everything. We're just talking about the big ones. So if I issue stock to repay a debt, or if I issue stock to purchase an asset, those are big transactions. I've changed my business by issuing the stock instead of using cash to meet my obligations. So FASB makes us put it in there. Another good example of this, when our investors bring in preferred stock or bonds and convert them to common stock, again, it changes my business. So FASB makes us put that information into our statement of cash flows. These are just a couple of examples. Again, the rule is any significant non-cash transactions would be listed. Another good one would be the purchase of an asset through a lease. So we are providing more than just cash flow information on our statement of cash flows. Now, the last thing I want to talk about in this segment are the differences between US GAAP and IFRS for the statement of cash flows. Now, the good news is that there aren't a lot of differences. Really, the only difference is in the choice. Of all the financial statements, the statement of cash flows looks most similar between US GAAP and IFRS. Really, what they've done is just provided more flexibility. So interest revenue, which under US GAAP has to be operating, they've said, you know what, if you want to put that in investing where it logically makes sense, go ahead. Interest expense has to be operating under US GAAP. Under IFRS, you can keep it in operating or you can stick it in financing. Dividend revenue, operating or investing. Dividends paid, operating or financing. Even income tax expense, or excuse me, cash paid for income taxes, can be assigned to all three sections if we want to. So if I know that I have a cash effect from retiring a bond early, then I could put that cash effect of the tax consequence down in cash flow from financing activities, along with the cash paid for refinancing that bond. So again, it's a flexibility issue, not really a difference in the way we do any of the calculations or any of the numbers that we present, just where we put them. The other caveat to this under IFRS is that once you decide how you're going to classify them, you have to be consistent between periods. So you can't just make it like an Easter egg hunt and put interest in operating one period and then in investing and then back to operating and then operating for 2 years and then down to investing. No, you got to be consistent with your decision. In addition, companies are not allowed to put non-cash items on the statement of cash flows. Under IFRS, you have to put them in the footnotes. So they still require that we present them. You just can't put them on the statement. There are a few things that the IASB believes need to be reported to our investors as actual cash amounts. So even if you do an indirect style statement of cash flows under IFRS, you are going to show cash paid for interest, cash paid for dividends, cash received as interest, cash received as dividends, and cash paid for taxes, all as specific line items. So unlike US GAAP, where you have your net income number and then you're changing interest payable, and somehow between that you're supposed to figure out what cash paid for interest is, and you can, the information's there, you just have to dig a little bit. Under IFRS, you don't dig at all. They tell you cash paid for interest was this much, and they simply don't include it in the net income number that they present on the statement of cash flows, and they don't include the adjustment. They just have the actual line item. So that right there is probably the biggest change on the statement of cash flows, because it actually changes what numbers show up, but it doesn't affect the totals. So under IFRS, your income number can be totally different under IFRS than US GAAP. Your balance sheet can have different total assets or total liabilities or total equity or all three from IFRS to US GAAP. Your cash flows is going to come out to the same amount under US GAAP and IFRS because we're dealing with cash. It's in the bank. So there's really not that much flexibility with what numbers we present. It's just how we present them. The only exception is this very last line item. And that's what we do with bank overdrafts. An overdraft is a protection. It's a mini line of credit that companies get with their bank account so they don't have a bounce check. So if you write a check that's too big, the line of credit kicks in and they go ahead and they cover it, and then they come back to you and they charge you interest, and you have to deposit more cash and make a payment on this overdraft. Under US GAAP, if that's a big amount and you're using it, then you go ahead and put it on your statement of cash flows, it's on your balance sheet, etc. Under IFRS, whether you use it or not, it gets included as part of your cash and cash equivalents number. That's your beginning and ending balance on your statement of cash flows. So you're not just showing it if you use it and it's big, you're showing it all the time. Now, we talked about a lot of conceptual information about the statement of cash flows. It's time to start talking and start doing. So when we come back, we'll be talking about the steps to creating a statement of cash flows and then starting an example. We'll see you then. Thanks.